If you're a creator in the UK or Europe, the financial landscape is undergoing a seismic shift in 2025. This isn't a minor tweak, it's a fundamental reset of the rules governing your income, your savings, and your future. We're talking major changes to UK national insurance, the complete abolition of the pension lifetime allowance, and a new world of tax-smart opportunities opening up across the EU. It can feel overwhelming, but these changes could be your biggest financial advantage yet. In the next few minutes, we'll cut through the jargon. I'll show you how to navigate this new terrain to not just protect, but significantly boost your income, covering everything from smart SIP strategies to little-known pension hacks for the internationally minded creator. Let's start with the big one in the UK, national insurance. For the self-employed, the main rate of Class 4 NICs has been cut from 9% to 6%, and Class 2 NICs are gone. This is a direct cash injection back into your business. But the bigger story for long-term wealth is the death of the lifetime allowance. This was the cap on how much you could save into your pension without facing a massive tax charge. It's gone. For high-earning creators, this is a game changer. It means you can now build a much larger pension pot, tax efficiently, giving you unprecedented freedom to plan for retirement without arbitrary limits holding you back. So, how do you take advantage? Your self-invested personal pension, or SIP, is now more powerful than ever. You can contribute up to £60,000 a year and get tax relief. Combine this with your annual £20,000 ISA allowance for tax-free growth and withdrawals, and you have a formidable wealth-building machine. But what if you're a digital nomad or planning a move to the EU? You might want to look into a qualifying recognized overseas pension scheme, or QROPS. This allows you to transfer your UK pension abroad, potentially offering more investment flexibility and different tax rules that could be highly beneficial depending on your new country of residence. It's a complex area, but an essential one to explore. Now, let's talk about the modern creator's portfolio. It's not just stocks and shares anymore. Many of you are investing in or even being paid in crypto and other digital assets. Tax authorities are watching this space closely. In the UK, profits from crypto are typically subject to capital gains tax. You have an annual exemption, currently £3,000, before you pay tax. It is crucial to keep meticulous records of every transaction, the date, the value in pounds sterling, and what you did with it. Using tracking software isn't just a good idea. It's essential to stay compliant and avoid nasty surprises. Finally, let's zoom out. Financial planning isn't just about numbers. It's about building a sustainable career. The pressure to be always on can be immense, and financial stress is a huge contributor to creator burnout. Setting up these automated, tax-efficient systems frees up mental energy, allowing you to focus on what you do best, creating. And don't forget to look for support. Both the UK and EU offer grants for digital and creative businesses. A quick search for Arts Council funding or Creative Europe grants can uncover opportunities to fund your next big project. Your financial health and your mental health are two sides of the same coin. Plan for both. Here's the quick map. UK creators, NI changes plus SIP versus ISA in a post-LTA world. EU creators, PEPP basics and top national deductions like Germany's Basisrente and France's PR. Then a simple action plan. Welcome back to our financial forecast for creators. The landscape of self-employment is constantly evolving, and staying ahead of the changes is key to not just surviving, but thriving. We're kicking off with a significant update for our UK-based self-employed creators, stemming from recent government announcements. Let's dive into the changes to national insurance, because they're designed to put more money directly back into your pocket. First up, let's talk about Class 2 national insurance. For years, this has been a fixed, weekly payment that most self-employed people had to make. Think of it as your entry ticket to certain state benefits. But as of April 6, 2024, this has been effectively abolished for the majority. If your profits are above £12,570, you no longer have to pay Class 2 contributions. That's an immediate, straightforward saving of £3.45 per week, which adds up to over £179 a year. It might not sound like a fortune, but in the world of freelancing, every single pound counts. Now, the crucial detail here is about your state pension. You might be thinking, if I'm not paying, does that mean I'm not qualifying? And that's a great question. The government has recognized this, so for those with profits over that £12,570 threshold, you will continue to receive a qualifying year credit towards your state pension, just as if you had paid. It's the best of both worlds. You save the money, but you don't lose the long-term benefit. But the good news doesn't stop there. The bigger change comes to Class 4 national insurance. This is the contribution you pay as a percentage of your annual profits. The main rate was cut from 9% down to 8% in April 2024, and it's set for another significant drop to just 6% from April 2025. This is a substantial tax cut specifically for the self-employed. It applies to profits between the lower limit of £12,570 and the upper limit of £50,270. Let's make this real with a quick case study. Imagine a creator, let's call her Alex, who makes a profit of £40,000 a year. The cut from 9% to 8% saves her around £274 in the 2024-25 tax year. When the rate drops again to 6% in 2025-26, her total saving on Class 4 contributions, compared to the old 9% rate, will be over £820 per year. Add in the abolished Class 2, and Alex is looking at a total annual saving of around £1,000. So what does this mean in practice? It's improved cash flow. That £1,000 could be a new lens for your camera, a significant marketing budget for your next project, or the subscription to that premium software you've been eyeing. Or, perhaps even more importantly, it could be a contribution to your financial well-being, a buffer for a quiet month, or the funds to take a well-deserved break to recharge your creative batteries without financial stress. Now, a very important note. What if your profits are low, say under £6,725? In this case, you don't get the automatic credit for a qualifying year. This is where you must be proactive. You have the option to make voluntary Class 2 contributions to ensure you don't get a gap in your national insurance record. At around £3.45 a week, it's one of the most cost-effective ways to build up your entitlement to the full state pension. The key takeaway is this: your cash flow improves, but you must check if voluntary contributions are necessary to protect your future. Your first step should be to go to the gov.uk website and check your national insurance record. It will show you exactly how many qualifying years you have and whether there are any gaps you can fill. Think of your state pension as the foundation of your retirement plan. It's vital to make sure that foundation is solid, and these rules are relevant even if you're embracing the digital nomad life. If you remain a UK tax resident while working abroad, these NI changes apply to you. Similarly, if you're generating income from digital assets like crypto and it's classed as trading income, these NI reductions could lower your overall tax bill. It all highlights how crucial it is to understand your financial obligations, no matter how or where you earn your income. Proactive planning is your superpower. The retirement savings landscape has changed. The Lifetime Allowance, a cap on pension savings, is gone. This is a massive opportunity for creators. In its place are two new limits on tax-free cash. First, the Lump Sum Allowance, or LSA, caps your personal tax-free withdrawal at £268,275. It's the new ceiling on that classic 25% tax-free cash. Second, the Lump Sum and Death Benefit Allowance, or LSDBA, is a higher cap of £1,073,100. This includes tax-free cash you take, plus any paid to your beneficiaries when you die. So while you can now grow your pension pot indefinitely, the way you access it tax-free is more defined. This sharpens the age-old question for creators deciding where to invest their hard-earned money. So, which vehicle should you prioritize to build your wealth, the SIPP or the ISA? Let's break them down. Let's start with the self-invested personal pension, or SIPP. Its superpower is upfront tax relief, a government bonus for saving. For a basic rate taxpayer, every £80 you contribute becomes £100 in your pension. If you're a higher rate taxpayer, it gets even better, as you can claim back an additional 20% via self-assessment. That means a £100 contribution effectively costs you just £60. For creators, it's a powerful tool to reduce a tax bill in a good year. You can contribute up to £60,000 a year, or 100% of your earnings, whichever is lower. And crucially, if you have a lean year, you can use the carry-forward rule to mop up unused allowances from the previous 3 tax years. This is a game changer for freelancers. Take Alex, a freelance videographer. After a massive project, Alex faced a huge tax bill. By using their annual allowance plus unused allowance from previous years, they put £100,000 into their SIPP. This dramatically reduced their taxable income for the year. The catch? That money is locked away until you're at least 57. But this enforced discipline ensures your future self is taken care of. Now, the individual savings account, or ISA. Its superpower is flexibility and tax-free growth. You can invest up to £20,000 each tax year. You don't get tax relief on the way in, but all growth is completely tax-free, forever. And most importantly, you can access it anytime without penalty, making the ISA perfect for your medium-term goals. Consider Benita, a graphic designer saving for a studio down payment. Her money is in a stocks and shares ISA, growing tax-free. If a client pays late, she can withdraw funds instantly. If she wants to take a sabbatical, her ISA can fund it. It's her freedom fund, a crucial buffer against the unpredictable nature of freelance life. What if your creative journey takes you beyond the UK? For digital nomads planning to move abroad permanently, you might transfer your UK pension to a COROPS. This consolidates your funds in your new country, but it's a complex move with major tax implications. Professional advice here is essential. And what about crypto and NFTs? In the UK, HMRC views crypto as property. This means when you sell or trade it, it's a disposal for capital gains tax purposes. You cannot hold crypto directly in a SIPP or ISA, so these investments require meticulous record keeping to stay compliant. This all ties into a crucial aspect of freelance life, the link between financial well-being and mental health. The feast or famine cycle can be incredibly stressful. A robust financial plan isn't just about returns, it's about creating a safety net that reduces anxiety. Knowing your long-term future is secured in a SIPP, while your medium-term goals are covered by an ISA, frees up mental bandwidth to take creative risks. Ultimately, the debate isn't SIP-ISA. For most creators, the optimal strategy is SIPP-ISA. Use the SIPP for what it does best, capturing valuable tax relief to compound for your long-term retirement, especially in your high-income years. And use the ISA for its unique strengths, providing a flexible, accessible, and tax-free pot of money for life's opportunities and emergencies. Many successful creators do both, funneling money into their SIPP for powerful tax-boosted compounding, while building up their ISA for accessible, tax-free wealth. It's a hybrid strategy for a hybrid career. VAT threshold is £90K. If you're nearing it with brand deals, merch, or digital services, plan ahead. And making tax digital for income tax starts April 2026 for many. Get your bookkeeping clean now. Bank feeds, invoicing, receipt apps. EU creators on the move? The Pan-European Personal Pension, PEPP, is designed to be portable across countries. It's still early stage in many markets, but worth a look if you live or work in multiple EU states. Germany's Basisrente, Europe, gives tax-deductible contributions for self-employed. It's annuity-like and less flexible, but for high earners, it can be a strong tax shield. France's PRR lets you deduct voluntary contributions within annual limits. It's flexible across compartments, individual, occupational, with potential employer matches if applicable. For self-employed creators, the individual PR is the go-to. In other EU countries, national products can beat PPE depending on reliefs. Always compare relief now versus taxation later, and flexibility versus guaranteed income. Here's the creator decision tree. UK. If you want maximum tax relief and can lock funds, prioritize SIPP, add ISA for flexible growth, track your LSA for withdrawals. EU. If you're mobile, review PP. If you're settled, compare national options like Basisrente or PR based on tax bracket and horizon. Automate monthly contributions. Use separate business and tax savings accounts. Reprice your work to include employer-equivalent pension contributions. And track your allowances. SIP ISA in the UK, Basisrente peer limits in the EU. Comment UK or your EU country plus income range, and I'll reply with a starter setup. This video is education, not personal tax advice. Check official guidance or a qualified advisor for your situation.